You're probably going to pay more in taxes this year than you actually need to. Not because you're careless, not because you're doing anything wrong, but because the tax system quietly rewards people who know specific strategies and ignores everyone else. Here's the frustrating part. The moves that could save you hundreds, even thousands, aren't hidden. They're written directly into the tax code, but most people never learn them. They file the same way every year. They take the standard deduction. They assume everything is handled. It's not. And the money left behind doesn't just disappear once, it compounds. Year after year, it turns into tens of thousands of dollars that could have been invested, growing, building real wealth. No one is going to remind you. Not the IRS, not your employer, not your bank. Your tax situation is your responsibility. So in this video, we're breaking down 13 tax moves that can still save you money in 2026. Some are simple, some require planning. All of them are legal and massively underused. The first move, maximize your retirement contributions. If you have access to a 401k or similar plan, every dollar you contribute reduces your taxable income. That means immediate savings. If you're in a 22% tax bracket, contributing $10,000 saves you $2,200 in taxes right now. Most people stop at the employer match. That's a mistake. Anything beyond the match still lowers your tax bill. If you can't max it out, increase contributions slowly, even 1% per raise. You won't feel it, but your future will. The second move, use a health savings account. An HSA is one of the most powerful tools in the entire system. It gives you triple tax benefits. You don't pay tax when you contribute, you don't pay tax while it grows, and you don't pay tax when you withdraw for medical expenses. Most people use it like a spending account. The smarter move? Treat it like an investment account. Pay medical costs out of pocket, let the HSA grow for decades, and use it later when healthcare costs are highest. The third move? Be strategic with deductions. Most people take the standard deduction without thinking, but timing can change everything. Instead of donating to charity every year, group multiple years into one. That pushes your deductions above the threshold and increases your tax savings. Same spending, better timing, better outcome. The fourth move, tax loss harvesting. If you invest in taxable accounts, this matters. When an investment loses value, that loss can offset gains. Less tax, more retained money. You can even deduct losses against income, up to $3,000 per year, and carry the rest forward. Losses aren't just losses. They're tax tools. The fifth move, the backdoor Roth strategy. Even if your income is too high for a Roth IRA, there's still a way in. Contribute to a traditional IRA, then convert it to a Roth. Done correctly, this lets your money grow tax-free for decades. This strategy exists. Most people just never use it. The sixth move, claim education credits. If you or your dependents are in school, this can mean thousands. The American Opportunity Credit alone can provide up to $2,500 per student per year. That's not a deduction, that's a direct reduction in your tax bill. The seventh move, the Savers Credit. This one is overlooked, especially by lower income earners. If you contribute to retirement accounts, the government may give you a credit on top. In some cases, your contribution is effectively discounted by up to 50%. You save money and get rewarded for it. The eighth move, use the 0% capital gains bracket. Yes, it exists. If your income is below certain thresholds, you can sell investments and pay zero federal tax on the gains. That means you can reset your investment value without a tax hit. Timing matters more than people realize. The ninth move, maximize the child tax credit. If you have children, this is one of the most powerful benefits available, up to $2,000 per child, and a portion of it is refundable, meaning you can receive it even if you owe nothing. Many families qualify. Fewer maximize it. The 10th move, claim energy efficiency credits. Upgrading your home? That can reduce your taxes. Solar panels, heat pumps, insulation, many improvements come with credits, sometimes worth thousands. These upgrades don't just save energy, they reduce your tax bill directly. The 11th move, deduct major medical expenses. If your medical costs exceed a certain percentage of your income, they become deductible. Most people ignore this until a big expense year, but if you plan correctly, you can stack expenses into 1 year and maximize the benefit. The 12th move, home office deductions. If you're self-employed, this matters. A dedicated workspace can reduce your taxable income significantly. It's not about bending rules. It's about using the ones that exist. The 13th move: give smarter, not just more. Donating appreciated stock instead of cash can eliminate capital gains taxes. Same donation, better tax outcome. There are also strategies like donor-advised funds and IRA distributions that most people never explore. Here's what all of this comes down to. The tax system isn't just a system of rules. It's a system of incentives. And if you don't know the incentives, you miss them. Most people approach taxes reactively. They report what happened. But the real advantage comes from planning what happens. You don't need to do everything. Even applying 2 or 3 of these strategies can save you thousands every year. Over time, that becomes life-changing money. Because this is the truth most people ignore. Making more money matters, but keeping more of what you make matters just as much. The difference between someone who understands taxes and someone who doesn't isn't knowledge, it's wealth. Now you know the strategies. The only question is whether you'll use them.